A single sheet of standard paper weighs approximately 5 grams. In early June 2026, a 5-gram document signed by Russian Finance Minister Anton Siluanov arrived at the Kremlin, exposing a structural fissure in the financial foundations of the world's largest landmass. The Financial Times obtained the letter, which details a mathematical paradox that state television cannot disguise. Russia currently directs nearly 40% of its entire federal budget toward a military campaign it can no longer afford to sustain. The numbers have stopped adding up. Tracing how a resource superpower arrived at this ledger crisis reveals the physical architecture of its wealth. For 2 decades, the Russian state functioned not as a diversified market, but as a massive thermodynamic pump. Raw crude oil flows out of Siberian permafrost through thousands of kilometers of steel pipelines into 33 major refining complexes located in the Western Territory. These specific facilities do not merely process petroleum. They generate the structural liquidity of the regime. The critical nodes of this network are the catalytic cracking units. These monolithic industrial towers operate under constant internal pressure and temperatures exceeding 500 degrees Celsius to transform cheap, heavy crude into high-value diesel, gasoline, and jet fuel. The state collects a 25% tax premium on these refined products rather than raw oil. This specialized financial stream provides the exact cash flow that funds the public sector, secures civil compliance, and underwrites military expansion. When Moscow launched its full-scale invasion, its economic planners calculated that global energy dependency would insulate this mechanism from external shocks. They designed a war budget based on a precise equilibrium. High global oil prices would generate an uninterrupted stream of hard currency, and this currency would absorb the friction of international sanctions. For 24 months, the mechanism performed as intended. The state injected billions into defense factories, creating an artificial boom that drove economic growth up to 5%, while masking the underlying structural decay. For the fiscal year 2026, the Kremlin codified this militarized economic model into law. It allocated $238 billion directly to defense and security sectors. This single allocation exceeds the entire gross domestic product of industrialized European nations like Romania or New Zealand. It commands nearly 40% of every ruble the federal government intends to extract from the economy. The leadership treated this astronomical sum as a fixed, manageable cost of geopolitical leverage. They failed to calculate the physical limits of their own financial system. The Finance Ministry's internal audits now reveal an immediate, unbudgeted cost overrun of $28 billion on top of that record allocation. Under the ministry's own realistic negative scenario, this overrun doubles to $56 billion. The sheer kinetic consumption of the war is outstripping the bureaucratic apparatus's ability to print or reallocate capital. The structural rupture materialized during the first 4 months of 2026. The federal budget deficit exploded to $82 billion. Comprehending the velocity of this fiscal collapse requires comparing it to the Kremlin's own annual safety margin. The government projected a $53 billion deficit for the entirety of 2026. The state blew through its annual deficit limit before the spring snows had fully melted, recording the largest fiscal gap since the invasion began. This fiscal hemorrhaging explains why the total accumulating weight of the crisis has reached $275 billion. This figure represents the material sum of overruns, uncollected revenues, and destroyed physical assets pressing down on a rigid capital ceiling. Anton Siluanov is a technocrat whose career depends on maintaining the solvency of the state. He is a guardian of the regime, not its opponent. Yet, his confidential letter demands an unprecedented domestic retreat. Siluanov has formally requested the government to freeze $40 billion in non-military outlays for this year alone. This measure deliberately spares the defense sector while stripping the civil economy. It halts the construction of federal highways, suspends the modernization of regional hospitals, and terminates the maintenance of municipal infrastructure across 11 time zones. By the year 2028, this mandatory spending freeze escalates toward $100 billion. The state is systematically starving its own territory to keep its war machine fed. This is no longer a functional national budget. It is economic triage on a continental scale. A profound division has now opened within the state apparatus between the monetary authorities and the security services. Central bank officials see the physical limits of foreign reserves, while military commanders demand infinite funding for the front line. Senior financial officers have recently bypassed standard protocols to warn the presidency directly that war spending has become unsustainable. The momentum has officially reversed. The pro-Kremlin Macroeconomic Center has cut its own growth forecast for the year in half, reducing it to a fraction of a percent. During the first quarter of 2026, the gross domestic product did not merely slow down, it contracted by 0.2%. The war economy that previously simulated strength is now moving backward, locked in a loop of escalating costs and diminishing returns. The state has reached the exact inflection point where the financial mass required to sustain the invasion is actively dismantling the domestic engine that funds it. The collapse of a complex industrial system does not begin with a sudden explosion. It begins with an asymmetrical cost equation. A specialized long-range drone costs $20,000. The atmospheric residue distillation column it punctures at the Ryazan refinery costs $400 million to engineer and requires 2 years to manufacture under sanctions. By June 2026, this severe mathematical imbalance had systematically disabled 24 of Russia's 33 primary refining complexes. The physical destruction of these cracking units did not just halt production lines. It triggered an irreversible domestic chain reaction through the deep tissue of the state. The immediate consequence was a localized vacuum of refined fuel. When the Moscow and Yaroslavl plants reduced their output to a fraction of capacity, the Kremlin faced a binary choice: allow domestic logistics to freeze or sacrifice international trade. The administration enacted an absolute embargo on gasoline and jet fuel exports running through November 2026. This tactical intervention insulated domestic consumers but instantly severed the state's most lucrative pipeline of clean foreign currency. The machine designed to convert crude oil into geopolitical leverage began to choke on its own raw material. A non-functioning refinery creates an immediate logistical crisis at the oil wellhead. The extraction infrastructure in Western Siberia operates under extreme geographic constraints. If an operator shuts down a well in the permafrost to offset the lack of refining capacity, the fluid within the shaft freezes solid, permanently destroying the geological pressure of the reservoir. To avoid total asset destruction, the state had no choice but to keep pumping raw crude and force it onto the global maritime market. This forced dumping explains the sudden 15% surge in Russian crude exports through Western ports during May. This volume did not signal market dominance. It signaled structural desperation. Because the state could no longer sell high-margin refined fuel, it sold the raw, uncracked crude at a profound structural discount. To bypass international sanctions, Moscow relies on a shadow fleet of aging, uninsured tankers. The maritime freight costs, combined with the mandatory discounts demanded by buyers in New Delhi and Beijing, eroded the profit margin to near zero. The state expanded its physical exports while its net revenue collapsed. This revenue implosion immediately collided with the domestic printing press. To sustain the production of armored vehicles and artillery shells, the government injected trillions of fiat rubles into the defense industrial base. This massive monetary expansion occurred while the domestic supply of civilian goods was actively shrinking due to import blockades. Too many rubles are now chasing too few physical products. The inevitable result is aggressive, systemic inflation that threatens the daily survival of the population. To prevent a total currency collapse, the central bank deployed the ultimate financial countermeasure. The monetary authorities raised the sovereign benchmark interest rate to an extraordinary 21%. This drastic action temporarily arrested the ruble's slide, but it effectively paralyzed the civilian corporate landscape. In the modern industrial ecosystem, no standard commercial enterprise can operate profitably when the cost of capital exceeds 20%. The high interest rate acted as a financial tectonic shift. Non-defense companies can no longer secure short-term credit to purchase raw materials or meet weekly payroll. They cannot refinance the massive mountain of corporate debt accumulated during the pre-war era. The system has responded by fracturing from within. 48% of all Russian businesses now officially report severe payment delays from their commercial partners. The corporate landscape is locked in a compounding chain of default risk, where the failure of a single agricultural distributor or logistics provider instantly bankrupts dozens of dependent enterprises. This corporate paralysis is compounded by an absolute depletion of the human architecture. The war has engineered a domestic labor vacuum of 5 million workers, frontline casualties exceeding 30,000 men per month. Combined with mass wartime emigration and the reallocation of technicians to three-shift ammunition plants, have stripped the civilian economy of its core workforce. Agriculture, urban transit, and food processing plants have no available labor pool from which to recruit. To retain the remaining skeleton crews, civilian businesses must artificially inflate wages. Yet, because these wage hikes do not correspond to an increase in physical productivity, they simply feed the broader inflationary spiral. The central bank remains trapped in an architectural loop. It must maintain prohibitive interest rates to suppress the domestic consumption caused by wage panics. But these exact rates are the mechanical force destroying the companies trying to pay those wages. The final buffer holding this fracturing system together is the liquid fund of the National Wealth Fund. This is the state's ultimate sovereign reserve. In 2021, it held over $120 billion in usable foreign currency and gold. By June 2026, years of continuous deficits, emergency corporate bailouts, and domestic fuel subsidies have eroded this reserve to less than $35 billion. The state is burning through its accumulated generational wealth at a velocity of several billion dollars a month. Every defensive maneuver implemented by the Kremlin now accelerates a secondary vulnerability. Freezing civil spending to fund the army destroys the domestic infrastructure that supports the economy. Pumping raw crude to save the oil wells collapses the global price of Russian energy. Raising interest rates to save the currency starves the very industries required to sustain the home front. The internal mechanisms of the state are no longer cooperating. They are actively devouring one another. The structural gears have stripped, and the engine is running on the friction of its own destruction. The financial hemorrhage has escaped the containment of the federal treasury and metastasized into the geographic periphery of the state. To shield the central apparatus, Moscow shifted the immediate financial burden of the war downward onto regional administrations. The consequences of this administrative maneuver are recorded in the localized balance sheets across 85 regions. By the opening of the summer season in 2026, 71 out of 85 Russian regions had entered absolute fiscal deficit. The consolidated regional shortfall has surpassed $34 billion, breaking every historical record since the dissolution of the Soviet Union. Odessa journal. This regional bankruptcy stems from a direct federal mandate. The Kremlin ordered local governors to fund frontline enlistment bonuses entirely out of regional cash pools to maintain the influx of 30,000 new soldiers per month. This single administrative decree drains 1 trillion rubles, approximately $13 billion, annually from local budgets. To satisfy this military quota, regional authorities have systematically cannibalized their own civilian systems. The donor regions, which previously generated the surplus capital that stabilized the state, recorded an 8.3% collapse in corporate profit tax collections. The new voice of Ukraine, the physical reality of this fiscal starvation, is visible in the structural degradation of the interior. Regional administrations have halted the maintenance of utility grids, zeroed out subventions for local public transport, and frozen municipal heating system repairs. The civilian population pays the primary price not through visible tax hikes, but through the literal decay of the physical environment that sustains them. While state factories forge artillery shells 24 hours a day, the regional infrastructure that connects those factories to the domestic economy is fracturing from a complete lack of capital. This structural decay has simultaneously penetrated the banking core. The prolonged application of a high interest rate has successfully broken the civilian corporate sector's ability to service its debts. The proportion of non-performing corporate loans has surged past 11% of the total national credit stock. Because civilian businesses cannot generate a 20% return on investment to cover their borrowing costs, they are defaulting on their obligations in a compounding chain reaction. Bofit.fe, Issue 1. This corporate default wave has directly compromised the stability of the domestic financial institutions. Between January and March 2026, the number of loss-making banks in the country nearly doubled, rising from 34 to 60. Currently, 19.7%, nearly 1 in 5 active banks in the Russian financial market, operates at a loss. The regulatory authorities have temporarily relaxed reporting standards to mask the true depth of non-performing assets. But this bureaucratic deception cannot generate physical liquidity. The banking sector is holding trillions of rubles in restructured corporate debt that will never be repaid. www.pravda.com Issue 2. Externally, the geopolitical strategy designed to rescue the regime has transformed into a mechanism of economic extraction. The state's reliance on non-aligned buyers has left it vulnerable to aggressive commercial exploitation. India and China do not act as strategic partners. They function as predatory arbitrageurs. Because European markets remain sealed, these Asian buyers enforce deep discounts on raw crude. While their state banks systematically escalate transaction fees to insulate themselves from Western secondary sanctions, the resulting trade mechanism traps Russian capital outside its own borders. Over 60% of these energy transactions are executed in non-convertible local currencies or specialized digital financial assets. The Kremlin accumulates billions of Indian rupees and Chinese yuan in foreign bank accounts that it cannot freely convert into hard currency or use to import critical industrial components. The state has effectively exchanged its finite natural resources for frozen digital ledger entries that offer no domestic purchasing power. The internal attempts to stabilize this crisis have arrived too late and possess insufficient mass. To offset the revenue collapse, the Finance Ministry implemented a sweeping corporate tax hike, raising the baseline rate from 20 to 25%. This intervention generated a temporary surge in paper revenue, but it simultaneously extinguished the remaining investment capacity of the non-military economy. 62% of civilian enterprises have recorded an immediate drop in net profits, and 15% have completely terminated their development projects. The state is actively taxing its industrial base into extinction to fund a single month of frontline consumption. Ukraine informed the system has passed the point of structural return because the leadership cannot halt the war without triggering an instantaneous economic depression. The entire simulated growth of the past 2 years is a mathematical artifact of military spending. The defense industrial complex is the sole sector generating employment and industrial output. If the Kremlin reduces military expenditures to balance the budget, the factories will halt, millions of specialized workers will enter immediate unemployment, and the synthetic gross domestic product will collapse. Moscow is locked in a terminal architectural paradox. It must continue spending 40% of its budget on the military to prevent an immediate industrial shutdown. But this exact spending is systematically liquidating